Hello, this is Mark Smith. It's October of 2015, and I hope that you've endured the rainy season on the East Coast. Hopefully, we now have some nice fall weather ahead of us. To accompany third quarter reports, we've prepared this brief market summary and outlook video. After 6 years of increasing market values, we finally hit the first major bump since August and October of 2011. Except for high-quality bonds, we see quite a bit of red on the global market summary this quarter. Within U.S. stocks, both large and small cap stocks were down, with small cap being down more. Within foreign stocks, we see a similar relationship. Developed country stocks were down, while emerging market stocks were down even more. Remember these relationships within U.S. stocks and within foreign stocks in a moment when we look at this year's investment themes. Except for high-yield bonds, the bond market rallied for modest positive returns. This reminds us once again of the benefits of diversification, even from low-yielding bonds. Commodities continued their dramatic slide in the midst of global shifts in both production and demand. It's very unusual to see an asset class with across-the-board negative returns like this, even out to 10 years. The positive to this is lower energy and input costs to producers and consumers, creating more disposable income, but from an investment standpoint, it has certainly been an area to avoid. Each month, when I meet with the investment team, there are about 50 slides that they use to explain current conditions and their thinking. The following 4 slides capture the main ideas. First, looking at the evidence report card shows some recent changes. In short, the overall picture has changed to mildly negative over the last quarter. All of that evidence has led the team to shift into risk management mode. By September 10th, volatility, or the amount of risk in portfolios, had been reduced to 82% of benchmark after being near 100% of normal risk levels as recently as mid-August. What's equally interesting is the way that risk exposures have been reduced. As the markets began to turn after mid-August, the team set an initial goal of moving portfolios to the 82% of benchmark level. However, instead of doing it all at once, trades were made on 5 different days, as shown here. The team followed a disciplined approach of de-risking portfolios, using counter-trend upmarket days when raising cash. So, some of the decline in the third quarter was reduced by the team's actions. Also note that another risk-reducing trade was made in early October. Finally, this brings us to the 4 themes the team has been following this year. The first 2 are intact, and I'll call your attention to the second point. Remember the results from the global market summary? Earlier this year, we highlighted the need to avoid valuation traps. This is where an asset class is measurably undervalued compared to other asset classes, yet the surrounding evidence says stay away. This theme has played out in U.S. small cap and emerging market stocks. Cheaper valuation, which we actually saw earlier this year, does not always lead to greater return, especially in the short term, and we are glad both of these asset classes have been avoided. Interestingly, neither small cap nor emerging market stocks are part of the benchmarks used in our performance reports, so the avoidance of these assets is not evident when you review your performance report. Back to the other 2 themes. This is where things have changed a bit and are reflective in the recent trades that we already looked at. As always, we appreciate your business and your confidence, especially in more challenging times. Please let me know if you have any questions, and as always, I look forward to talking with you soon.